TheoTrade. This is Don Kaufman, June 11th, 2021, hours after the cash close here on this Friday afternoon. Doing the weekend update here is a low market volatility transitory. With that, we're actually going to have a fairly detailed market update, but we're going to spend a tremendous amount of time on this weekend's update, kind of detailing some strategy moving forward in really what I expect to be a transition from what I would term incredibly low market volatility into what we can definitely anticipate some higher volatility, because quite frankly, the volatility, whether you're looking at historical volatility, which is the annualized standard deviation of past stock price movement, or implied volatility, which of course is how option risk is depicted moving forward, either one of them, they can't really go any lower. So effectively, we're going to be transitioning into a higher volatility marketplace. And hey, don't worry, it's transitory. Speaking of transitory, of course, we do have the Fed meeting coming up this very next week. But before we get there, again, let's give you a little bit of a market update on some of the action that we saw this past week and why and what really matters right now. One of the first things that's in play, this is a chart that I've been using pretty consistently. It's like a 30-day 1 hour of the S&P futures. And just one of the key points that it kind of delineates here is nothing more than, well, this. So I've kind of boxed it out here, but the vast amount of trade that has occurred, and now this is a period of, if you will, just shy of a month, but and that's what I've just boxed in right now. The vast amount of trade there occurring in the S&Ps inside of a 40-point range. I mean, it's phenomenally low, okay, in terms of, and again, this is actual or realized volatility, right? So this is actual price movement inside of the marketplace. Another way to look at this, and you can go over to studies, you can go to ad study and go to volatility studies and actually cruise up to historical volatility. Now, this is just standardized historical volatility. It's actually marked though as, again, this is 30-day 1 hour. So this would be literally like, averaged over 20 hours because it's an hourly chart. And you can see the historical volatility. And again, you can't even, make some of the stuff up, but you've actually got historical volatility at points during the week under 2%. And in fact, it closed the week at roughly 3%. So why does that matter? One of the first things that you have to be able to understand about this in incredibly, incredibly low, historical volatility here is simply in respect to the fact that, the VIX, take a quick glance at the VIX. The VIX is indicative of the SPX 30-day volatility, and that's sitting at roughly, 15, or let's call it 16%. I mean, throughout the course of this week, it's been, it's closer to about 16, even up into the 17 mark throughout the course of the week. So implied volatility, okay, if you're selling it right now, you're selling, let's just say an average of 17% implied volatility, but the market movement is between 2 and 3%, which is shockingly, okay, unique in that, again, the implied volatility of the marketplace, how options depict risk to be, is incredibly high versus realized volatility. And I'm going to tell you right now, okay, that's why we did this little, play on words over here. Is low market volatility transitory? Yeah, you better believe it, because the marketplace, historically speaking, doesn't give edge like this. It doesn't give up anything. And that's why you better be on your game right now and know, okay, exactly what kind of premium you should be selling. In fact, we're going to cover that in, okay, this weekend update just in a moment here. So giving you the market update, first and foremost, CPI came in. It was hot. Okay, but the market move was not. And I can't stress that enough. So can you even tell where CPI came out? Yeah, it was right here on Thursday. And, interestingly enough, that was the most volatility we saw in the entire week. Wow, we actually extended all the way from 42.10 up to 42.50. So you had a 40-point range of movement in the S&Ps. All right, but for the most part, what did we do? Well, we finished, for the most part, massively unchanged on the week. I mean, taking a look at the week as a whole, and I think one of the best ways to kind of delineate the week, and I do this each and every week, is I use the SPX, the mother of all products. But the SPX actually started the week here and ended the week here. I mean, where's here and here? Again, poking a little fun at the lack of movement in here. The marketplace roughly started the week at 42.30, closed the week at 42.47. You can call it a rally, you can call it anything you want. I call it inside of a 20 handle move, which is nothing more than noise in the marketplace. So the CPI came out, and again, inflationary data is hot right now, but that just puts the Fed, okay, much more on notice. Now, before I go and discuss a little bit about the Fed, the next thing we got to talk about, financials. Financials took an absolute beating. Now, this is something that I was highly critical about, of course, in last weekend's update. If you take a look at the financials and we bring this up in terms of auto expected moves, the financials, they actually cracked outside their expected move for the week. This is how the option market, of course, displays risk moving forward. And if you will, the edge, the lower edge of the expected move is roughly, let's call it 37.80. We are well outside the expected move at 37, about 38. So, tried for the corner and missed. So there is some decent amounts of volatility in the financials. Why does that matter? Because if you take a look at tech, specifically the QQQ, do you realize that the Qs, okay, and the NASDAQ here almost, okay, hit the upper edge of their expected move? What do the S&Ps do? Absolutely nothing. One of the things that I've been sketching out recently, okay, is here you ultimately have what? The NASDAQ, right? So the NASDAQ rips to the upside, the financials, okay, head to the downside. That's the XLF. The S&Ps skirt through the middle. Okay, the S&Ps, you have to understand at this point, they can't get out of their own way because the marketplace got bifurcated, all right? And it was bifurcated specifically by the movement inside of the bonds. Now, the first time in a long time that we've seen movement in the bonds. And if you're not looking at the movement in the bonds, you're missing the bigger picture here. The bonds absolutely unequivocally broke to the upside. In fact, when you do look at the bond market, take a look and go to adjust for contract changes, hit apply, hit OK, and you'll see the bonds broke out to the upside. And the moment that the bonds broke to the upside, it ultimately crushed the financials. Again, more on that in just a moment. Just giving you a quick update over here. Last but not least, in the major index products, don't just look at the S&Ps, which are trapped in the middle. The NASDAQ was kind of hot. Obviously, the financials, though, dragged the S&Ps, to a flat line. But hey, you got to talk a little bit about the Russell, the IWM. And the IWM, and again, if you're unfamiliar with this term, the Russell gets meat-loafed. So we have a little bit of an issue inside of the Russell, and I'll explain what this happens to be. But the Russell all over the board throughout the course of the week. I mean, the Russell cracked the upside of the expected move, pulled back, and actually landed on the upper edge of the expected move on the week. And when I say it got meat-loafed, there are a number of stocks that everybody's talking about, which is, AMC, the Blackberries, all right, Clove. I mean, I can go on for a half an hour about these stocks, and I kind of refer to these lately as the mom meatloaf stocks. That is a millennial kind of reference in there. Nevertheless, these stocks like AMC, their market cap has picked up so substantially, okay, that they're having influence specifically over the Russell. I mean, there is no way, shape, or form like should one individual stock impact something called, well, the Russell 2000, okay? But when you have something like AMC, which earlier this week had a $30 billion market capitalization, it became the absolute heavyweight inside of the IWM, and it's throwing the IWM around like a toy. So this is what I term the Russell gets meat-loafed for the most part. The Russell volatility is going to continue to be a big question. In fact, look at the deviation over here. Russell volatility, again, front month vol in the Russell, okay, is sitting at 21%. You know where the front month vol is, okay, or the front, I should say, week vol is in the SPX? Go tune into the SPX. What's front, day vol in here? You're looking at 6%. You want to get crazy? Go 7 days out. It's 12% vol. Russell volatility is roughly speaking almost double what it is inside of the S&Ps. So the reason I wanted to point that out is the impact, again, of these, individual meatloaf stocks is actually kind of a barrier inside of the Russell, and it is driving some of the Russell volatility quite considerably. All right, moving on from the market update. I mean, hey, lo and behold, I am not going to make anything of this week because this is nothing more than noise. What you needed to know for this past week of trade is that the financials got rocked. Tech ripped, and the S&Ps are trapped in the middle. That is the single most important concept. And if you want, you can take a look at that, and you can take a look in terms of visualize, look at the index products, Okay, nothing displays this better than we're sitting on a 50-50 advanced decline line after seeing greater degrees of correlation. All right, onward and upward from there. Okay, Jay Powell and the Fed are very much back. If you are aware, maybe unaware, if you look at this next week coming up, you're actually got another Fed meeting. So here comes the Fed. And at this point in time, you've actually coming off two very hot CPI numbers, which means the Fed, they're going to have to mention it in some way, shape, or form. Now, I am not going to build this up too much because what the Fed is likely to say, it's neither here nor there. They're going to talk about inflation being transitory. However, at some point in time, they are going to talk about the possibility of tapering some of the bond buying. It's being done at $120 billion a month, and that's between, of course, treasuries and mortgage-backed securities. Nevertheless, there's going to be discussion of that. The bonds, though, once again this week, it's the most important thing. It's not about the Fed. Like, listen, okay, the one thing I want to point out, okay, in this, and yeah, I put the Fed in here. The Fed is the catalyst. It's the volatility catalyst. You have to look at the Fed as nothing more, okay, than the entire marketplace is just a pool of gasoline. The Fed's going to just be lighting a match and throwing it into it. The bonds, though, they're going to take center stage. And I cannot stress this enough. When I say the bonds are going to take center stage, another way to display this is to look at the TLT. Now, I did this past week, and I'm going to do it again. Why? Because the bonds, once again, their volatility is actually in a degree of backwardation. Look at this 7-day volatility, okay, is already jacked to 13.48%. All right, back week vol is actually dropped already to 12.92, and you're going to see a much larger deviation between front and back as the week actually starts. So coming into this next week of trade, all right, there's already a volatility deviation between front and back month, which it's almost like earnings once again is coming out inside of the bond product. And I said that this last week with CPI, which the bonds are what moved. I mean, you may say what you will about the S&Ps. Sorry, man, the bonds, they rocked. I mean, look at the bonds. Turn on auto expected moves. The bonds are outside their expected move. It got downright wicked inside of the bond market. Okay, but this coming week, this is the week where the bond market is going to influence the S&Ps. Okay, so one of two things is going to occur. One of two things are going to occur. And guess, listen, this is going to be a binary thing. When you get like that pool of gasoline and you get a catalyst like we're going to see, okay, here's what's going to occur. If the bonds break to the upside, it's going to be night for the XLF. Okay, the XLF, though, at this point, if it continues to break down, is going to start to drag the S&Ps underwater. All right, the other conversation piece. What if the bonds don't sell off? Okay, or should I say, what if the bonds don't rally? What if the bonds sell off? If the bonds sell off, okay, there's kind of an intermediary place here, like the 157, where the marketplace could be happy. But if the bonds actually take off heavily to the downside, again, if the bonds take off heavily to the downside, you may see slight recovery inside of the financials. But all of a sudden, that is when tech, okay, could be hit. And if tech gets hit, it's probably going to roll the financials over with it. You have an incredible catch-22 coming into this next week of trade. And again, say what you will, volatility is going to pick up, all right? We have a binary situation in the bond market once again, but any way you want to look at this, the marketplace, the only chance for a marketplace that's really going to rally, I want to make this clear, the S&Ps can rally. So long as the bonds throughout the course of the week would have to actually calm down, come into this 157 handle and hold. That would be kind of your rally. So you can't just look at this as bonds moving up or bonds moving down. No, the bonds can actually skirt right back through the middle. And if they do that, the marketplace is unequivocally going to rally. The marketplace, all right, when I say the marketplace, the S&Ps, they want the bonds back inside of this range. Anything outside of this range, and this range is like 158, okay, down to the neighborhood of about 155. It is a tight range. If you stay inside of that range, everybody's going to be happy. They're all going to hold hands, and the S&Ps are going to rally. Anything outside that range, it's dangerous. Okay, the bonds rally, it hurts what? Hurts financials. The bonds sell off big, it hurts tech. That's not a win-win situation, though, for the marketplace. Nevertheless, again, you got to look at the Fed as nothing more than the catalyst. Don't block out the noise. Like, you don't need to even listen to what they're saying. Okay. Yes, they're going to talk about tapering. You just don't know way the market, the way the market's going to interpret that. And I can't stress this enough, because if you saw that CPI was so hot, okay, well, CPI was hot, and yet the interest rates, the interest rates came down significantly throughout the course of this week. Usually when you get a hot CPI, what do you normally see? You see interest rates picking up. You're like, that's it, man. We got to raise interest rates. It's over. Okay. Well, we actually stalled out. And now, okay, we're going to wait for Jay Powell. All right. Next topic of conversation, volatility is transitory. Listen, all I was trying to point out here with volatility is transitory is volatility, okay, is lying dead on the floor. Now you can look at the VIX all day long. And I'm serious about this. You can look at the VIX all day long. The VIX is just not displaying, all right, some of the real risk in the marketplace because the VIX against 30-day, implied volatility, the SPX, a couple things that are still displaying degrees of risk. Number one, let's look at the dollar. So if you look at the dollar, I'm going to give you this for what it's worth. I think the dollar is actually ready to turn and burn back to the upside. I think that is an absolute unequivocal display of risk in the overall marketplace because in the end, where does everybody turn? If they get scared, okay, regarding anything in the marketplace, they'll actually turn to the US dollar. I'll tell you what, you should be a little bit scared coming into the Fed announcement because a lot of things can happen in the bond market that is not going to be satisfying for the S&Ps. So you should expect another bit of a bid to come into the dollar early on in the trading week. It makes a lot of sense to be buying dollar coming in early on in the trading week simply because, listen, it doesn't matter whether the Fed stays in the accelerator or not. Okay, there's danger out there. When there's danger, you got to mitigate risk. Moving to the dollar would be a good risk mitigation tactic coming into the Fed announcement. Next on the docket, SKEW. So for those of you that do not know SKEW is looking like a VIX, okay? But it's like an out-of-the-money option VIX. And there's only one way to really display this to you. Pull up like a full 10-year. Ladies and gentlemen, the highest SKEW ever recorded. When? Today. This was literally the highest SKEW ever recorded. What that effect, means, the out-of-the-money puts in the S&Ps have never traded, okay? The out-of-the-money puts in the S&Ps have never traded at a higher rate versus the out-of-the-money calls. So let's actually open this up. And I'm actually going to open up the 35-day. I know that SKEW is actually based on 30-day. So we're going to open this up, and we're actually going to look at implied volatility. Look at the out-of-the-money implied volatility. Now, again, I know I'm over here in the spiders, okay? And in the spiders, but look, out of the money implied volatility is all the way to like 41%. This is the kind of stuff that SKEW measures. It's way out of the money. You look at the way out of the money calls, okay, way out of the money calls, they're still having a bid in here. They're all the way down to like 9 or 10%. The differentiation between out of the money calls and out of the money puts has never been higher, which also alludes to the fact that it is an incredibly viable time to be able to sell premium, especially if you're selling some put premium. But you can't just go out there and sell naked because sooner or later, you know that volatility is going to pick up. So again, with the dollar getting a bid under it, okay, SKEW is the highest print ever, and volatility is still prevalent. Now, I say volatility is still prevalent, but you know what? You can't just base that on the SKEW. No, we shouldn't base it just on the SKEW. We should look at things like the VVIX. The VVIX is still north, okay, of the 110. It's in the VAMA zone, which is the volatility. This is duck and cover kind of territory. I mean, listen, traders are still hedging risk. They're hedging risk. How do we know that? The VVIX is actually still through the roof. 116 is a high print, the VVIX, all right? SKEW is the highest print ever. The dollar is on the bid, all right? Bonds are actually breaking out to the upside. You've actually got the XLF has got like one nail in the coffin over there. Like, what else do you need to see? That volatility, okay, it's not just transitory, it's a coming, right? The low volatility is what's transitory. Big volatility is forthcoming. Now, what to do in this kind of a marketplace? Sell premium in the lower vol. I am telling you, you can sell premium in this lower volatility. You can get away with it. Okay. Why? Because the out of the money premium is still, it is beautiful. Now, I'm not exactly alluding to the fact that you should jump into the SPX or the spiders, but if you're comfortable, you can go into the S&P options and futures. A lot of people might not necessarily have experience with options on futures. A couple of first things before we're going to go out and sell some premium. The SKEW is incredibly high. Okay. But when you open up option chains, and let's get crazy and open up a few chains out here. Let's go way out of the money. I'm talking, let's go way out of the money. Let's go like 81 days out. Why do I want to be involved in selling premium 81 days out? All right. Take a look at the implied volatility SKEW. So what you've actually got is front month vol. Front month vol is absolutely dead. Back month vol, still sitting close to like 20%. So there's juice out in these options out here. Okay. You got to remember though, the juice that you're looking at like 18 or 19%, okay, that's using a VIX style implied volatility. That's near okay, that's actually near options to the money, meaning that when you look at this calculation and it comes with 18%, that's not looking at the way out of the money stuff. That's looking at stuff that's, again, it's near to the money. When you start opening up 81-day options and you start going really far out of the money, like look at this. You're able to sell like the 2,800 strike, for what? Oh, well, let's get crazy over here. Here's a marketplace of the 2830 strike. Okay, it's 41% implied volatility. You're already selling like the equivalency of like a 40 VIX on that option. I'm not telling you to go out there and just sell, the put naked. No, you're actually going to have to get a hedge on. That hedge, okay, is brought to you by none other than the VIX. So why go out and actually use the VIX as a hedge? Because I'll tell you what, VIX hedges right now, they're trading dirt cheap because there's huge skew in the VIX too. But the skew in the VIX actually helps us. Look at this. All right, there's options in the VIX. Right here, like 26 calls are trading for like a 133 vol. Go a little further out of the money, like the 60 calls, they're trading for like a 190 vol. You buy these, sell these. Look at the skew. It's in your favor. Like people don't get this. You're able to actually sell huge premium further out in time, okay, inside of like S&P options on futures. Why do I select the options on futures? Margin. Margin is absolutely spectacular in here. Okay, so I can sell way out of the money premium, and people are deathly afraid of selling naked. Great. That's why I use the VIX as a hedge, right? Get your hedge on, sell some premium. And you know what? Again, how often are you going to be able to sell a 38 or 40, premium out of the money? I mean, we're so far out of the money. This is like the nosebleed seats out here at the 2,900 strike. You don't necessarily have to wait some 81 days to see the full degree of profitability. There's a huge amount of profitability that can be hit well before that. The other aspect is going further out of the money using a VIX hedge can help reduce negative gamma risk. There's a few ways you can also reduce negative gamma risk by actually, buying front month options and selling back month options. Because in this case, if the volatility, again, low volatility is transitory, what's ultimately going to happen, all right, is some of this short-term vol is actually going to go up. Okay, the back month vol though probably won't move. Why? Because in the short duration, the risk starts to hit these options, right? Short duration options is where the risk is going to start to grow. The back month options out here, which are all trading like, 20, 30% implied volatility. And when you start going out of the money, it's 40% implied volatility. These, they're not going to budge. The implied volatility in them is not going to budge. So it's a relatively safe way to go out there and sell some premium in what is a lower implied volatility climate. With that, last but definitely not least, on this week's update, expected move into the SPX. All right, there's some shocking stuff on this particular front. First and foremost, you are now coming into, you got to look at this for what it is and what it's worth. You're coming into now how many weeks in a row that we have not breached. The last major breach of expected move is way back here, coming into what? Early April. You've now gone 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks in a row. You have 9 weeks in a row that we have closed inside of the expected move. 9 weeks in a row that we've closed inside the expected move. But wait, there's more. You've actually got ultimately approximately 3 weeks that we haven't even tagged the upper or lower edge of the expected move. That, people, is statistically significant, that we have not hit the upper or lower edge of the expected move. This next week of trade, the expected move is going to go up. It goes from $53 in this past week of trade and actually jumps to $59.53. So when I tell you that the low volatility might be transitory, look, volatility is already picking up. Everybody knows that Fed is going to be the catalyst. Volatility is picking up inside of the bond market. What am I telling you this next week? You need to expect us hitting the upper or lower edge of the expected move. And this is when I'm absolutely unequivocally going to be trading with SPX butterflies. I'll be looking for the SPX to actually tag the upper end or lower edge of the expected move throughout the course of the week. If you're familiar with expected move butterflies, that is a decent trade on that particular front. With that, that's it for this weekend's update over here. Listen, we're coming into another kind of binary week. Get your risk in check, sell some premium even before the Fed announcement. I mean, again, when else are you going to get an opportunity to sell like 40, percent IV out there? With that, again, low market volatility is transitory, but expect that volatility to pick up. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.